Hey, everybody, welcome back to another episode. I'm your host, Brandon Cobb, a co-founder here at HBG Capital. Today, I got a fun guest on the show. He was schooling me in some stuff before. There's something that I don't know about the mortgage market, and I was learning some stuff, and I'm excited to share this with you today. I got Jeff Ball. He's the founder and CEO of Visio Lending, a co-inventor of today's investor DSCR loans. That's debt service covered ratio loans. And if you know what DSCR is, you're going to want to know what this specific loan is. Believe me, they're the nation's number one lender of rental loans with over 2.8 billion closed loans for single family rental properties. In 2016, Visio made history on Wall Street. They completed their first ever investor only single asset DSCR mortgage securitization. That's a mouthful, but we're going to cut into it. Since then, the company's completed 11 S&P rated securitizations totaling nearly $2 billion in DSCR loans, and this guy's been in the middle of it. Jeff, welcome to the show.
Brandon, thanks for having me. I'm excited to be with you.
Yeah, man, this is going to be fun. We were talking about this product and how it can help people really scale their portfolios. Before we jump into this, what's your story for those listening that don't know who you are?
So my story, I actually started out as a corporate securities attorney in Silicon Valley back in the mid 1990s. I was working with tech companies just as the networking boom was taking off, Cisco and a bunch of other networking companies. From being a corporate attorney, I was working on capital raising, whether it was in the public markets or I was working on mergers and acquisitions work. And from there, I then stepped into investment banking. Really through the sequence of a couple of acquisitions, I ended up at JP Morgan running the semiconductor device investment banking business out of San Fran. So I covered that globally. Super interesting job, but incredibly demanding. I was married, had two young kids at the time, and I literally was gone traveling all the time. So back in 2006, I decided I was going to pivot and really go out on my own. So I left JP Morgan and I moved from San Francisco to Austin, Texas, and became later that year, I got involved with founding a company called Econo Homes that from 2006 to about 2012, we bought and sold bank foreclosures all over the country. So we bought and sold about 12,000 bank foreclosures. And in the midst of that, we noticed that there really was a gap in the financing available for single family investment properties. Most of the financing that was available at the time, people were focused on fix and flip lending, construction type lending for rehabilitation of properties. Most of that financing was all local. It's country club money. There were small hard money lenders set up in cities all over the country, but there really weren't any national lenders. And so we had a bunch of capital partners that were interested in us spinning off and setting up a national fix and flip lender. We weren't comfortable with that strategy from a risk perspective, but we were really interested in how could you provide permanent financing for single family rental properties. And so just as, fortune would have it, we hooked up with a capital partner out of Southern California, a big credit fund. They were thinking about the very exact same issue. They had a mortgage-backed securities backgrounds. And so it's really interesting. We ended up our experience of buying and selling all these single family properties had given us good understanding and kind of domain expertise around how small investors operate around the country. Myself and my partners had enough kind of Wall Street experience to at least talk the Wall Street language. And so we were able to kind of meld what Main Street needed from these, in terms of investing in these properties and building portfolios of rentals, meld that with what did Wall Street really need in order to provide the permanent financing to finance these single family rental properties. So that's my background and kind of how Visio got started.
Yeah, this is really interesting because anybody who's ever tried to build a portfolio of single family rentals, you realize that there's a lot of hurdles you got to jump through when working with local banks. One is you're only going to be able to scale it. Like a lot of times they really don't like to go over, I think it's like 10 properties or something like that. You kind of just max out with. There's a lot of reserves that they want to see on hands. It's tough to get long-term financing. Typically they want a 5-10 year balloon, and what happens if rates have gone up and you can't refinance out? That's an issue. You're forced to sell your portfolio. So there's definitely some pain points I want to get to before we jump in. I'm curious. So Visio Lending, founded in 2016, over $2 billion in DSCR loans, and you were on what seemed like the foundation of that. That growth look like? Talk to us about the early days of getting with this credit financing company, partnering with them. How did y'all go about growing this new product?
Great. Yeah, it's a long and winding road. So as a financier, it's as we describe to new team members who join our company, we hire a lot of folks kind of at entry level who have no exposure to real estate investing or the lending business. I often describe it as a lender, you borrow money in order to lend money, right? So you borrow at one rate, you lend it out at another rate. It's very similar to how a bank functions. But as a mortgage company, it's actually, there's a lot of moving pieces. There's different types of financing that you use. And so to build a lender and to scale a lender, particularly in a nascent market, is pretty complicated, because each financier in the step wants to know that there's a subsequent financier that's going to take you out. And so take you out in terms of that there's a way for the first financier to get taken out by the next financier. And so in our case, what we really had to do is we had to get warehouse lenders comfortable with this DSCR product. And in order to get the warehouse lenders comfortable with this product, we had to get them comfortable that there was actually a permanent financing solution available in the bond market. And
Okay, real quick,
in
real
order,
quick, real quick.
yeah,
When you say warehousing lenders, what is a
yeah,
warehousing lender?
yeah, yeah. Sorry for the kind of the mortgage lingo. So a warehouse line, when we go to close a loan with an investor, it's actually, we only use like if we're making $100,000 loan to an investor, we're as a company only going to put about $5,000 into that loan, and we have a lender that's going to put about $95,000 into that loan. And
Okay.
so when that loan is closed, it sits on what's called a warehouse line, where it sits there temporarily, and then we actually move it from. So this is a credit, like a loan from in this case, it's a bank, where we can put loans on this warehouse line. We can warehouse them or hold them there. And we actually have two different types of lines. We have a temporary line that we use when we close the loan. And then once the loan dries out, all the documentation is completely confirmed, then it moves from a warehouse line to what's called an aggregation line, where we aggregate the loans, and we typically aggregate them into a pool of 150 or $200 million. And
Mm-hmm.
once we get to that point, then we take that pool of loans and we go to the bond market and we actually do a securitization. So in order to kind of build a lender, you've got to have all of those pieces. And
All
in
right.
our case, okay, yeah, you got a
Let,
question. Go ahead.
let's talk about this, because I'm going to try to put it in layman's terms, because I don't think my understanding ever graduated past third grade here. So warehousing loans. I'm looking at this in the sense that the loan is actually like a product. So we've got like
Correct.
a supply business where I'm buying materials overseas. I'm putting it in my warehouse and I'm sitting it there. I'm waiting for the opportunity
Right.
to go and use that product in the market. And it seems like you're doing the same. You're going to these banks and you're saying, "Hey, I'll put $5,000 in the warehouse. You put 95 in the warehouse, and you secure it, or you warehouse that loan for use. Once it's warehoused, you then have the ability to go out and say, okay, got this loan in the warehouse. I need to go find a home for it. And so you go out and you start aggregating it. Once you've got deals to fund, then it gets to the aggregation line and you're starting to draw down. You're moving the products out of that warehouse into the field. It's going into investment properties. It's getting lent out to these single family rentals or whatever that market is. And then it becomes an aggregate. Am I with you? Am I with you so far? Is that accurate?
You're tracking pretty close. Think of it
Okay.
as a single loan is when we make a single loan, that's a widget, a
Mm-hmm.
loan, right? And what we need is we need to get enough of those loans, usually about $200 million worth,
Mm-hmm.
in order to then access in the bond market securitization financing. And
Okay.
so, in any given month, we're closing, call it 300 loans. And so, an average loan size these days is around $300,000. So think of it as, if we're generating $90 million a month in loans, we could aggregate, $200 million worth of loans every 2.5 or 3 months. And then we can take those loans, we group them together, and we hire investment banks who take that pool of loans and they actually sell bonds that are secured by those loans to provide permanent financing for those. And that's kind of the trick in this whole thing. We didn't create this, but the thing about a DSCR loan is, in your introduction, you mentioned that, hey, financing from a bank. If you go to a local bank, a bank is they might finance your single family rental property, but they're going to only give you probably a 5 or 10 year term. It'll have a 30-year amortization in it. So your payment's driven off a 30-year amortization. But after 5 or 10 years, they're going to require that you pay them back. And the reason is because the regulators really require that of them. They don't let the banks write 30-year mortgages with 30-year terms because the banks don't have a good way to line that loan up against their own financing that's got 30-year term on it. And so the securitization market offers us long-term financing that we can match up on our DSCR loans that have a full 30-year term. That's one of the important advantages of a DSCR loan. It's got a 30-year AM, but it's also got a full 30-year term. So the investor that uses that loan knows they don't have to refinance it unless they choose to, and they don't have to sell the property unless they choose to.
I want to talk more about that because that's it solves a huge problem in the market. Let's talk about the securitization. So you've got a lot of these loans. You've gone to the banks and said, hey, I got $5,000 down, give me 95. I'm going to lend this money. You warehouse it. It gets aggregated and essentially sold to Wall Street, or you go to Wall Street and Wall Street says, okay, I'm going to securitize these loans through a bond. Walk us through that. Why does that need to happen?
Wow, that's a great. So for any of your readers who have or any of your watchers who have ever seen The Big Short, there's a great scene in The Big Short about how securitizations work. But the way to think of a securitization, so once we've aggregated a pool of $200 million worth of loans, so every month when people make their payments on those loans, there's a big pool of money that comes in, right? There's, call it 700 loans there. And so let's just assume everybody makes their payments. There's 700 payments coming in that month. And what happens in a securitization is the Wall Street takes that pool of loans, and what they do is they issue bonds, which is like a promissory note, out to other investors. And there's different classes of bonds. Think of it, we talk about it as a waterfall. And some of the stuff's kind of complicated, but think of it as a waterfall. So at the top of the waterfall, you've got your investment grade rated bonds. So maybe your AAA bonds, your AA, your single A, okay? So what Wall Street does is they say, we've got $200 million worth of loans. We're going to issue $190 million worth of bonds, and we're going to break it up into tranches, the most senior being the investment grade. And at each one of those levels, they're going to pay different interest rates. Okay. And so, and the most senior have the least amount of risk, and the most junior bonds have the highest amount of risk. And so then when the payments come in each month on that pool of loans, they take the pool of cash that came in on the payments, and they run it through the waterfall. So the people at the very top, the investment grade people, get paid first, then the AA's, and then the single A's. And so what it allows is for bond investors to essentially look at the offering and say, you know what, relative to the risk, I like the return on the AA's, or I like the return on the BB's. And so it's a way of bringing capital in and aligning risk with what the bond buyers are willing. Different types of bond buyers have different risk levels and different return requirements. For us, the benefit of it is, again, as I said, the financing is long-term, meaning it lines up well with the fact that our loan has a 30-year term. It's very cost-effective for us as well, in terms of it's less expensive than like the financing on our aggregation lines. And then there's some other kind of more technical nuances of why that financing is appealing. The important thing for bond investors is these loans have to have very good performance characteristics, and they do. Again, we've originated now over $3 billion of this, and this has become a much more mainstream product in the market. And these loans perform extremely well, and we can talk about maybe why that is. But as we talk
Yeah.
about what's required to qualify,
Okay. So just to break that down, you get $200 million of loans that are aggregated, right? 700 different individuals or families all pulled together. You go to Wall Street. Wall Street, it sounds like they're purchasing these loans, but they're chopping them up into multiple layers. And Wall Street makes money by selling the different classes. You got the class A at the top, the triple A. You got the, just call it for simplicity terms, the triple B and the triple C and triple D, right? I'm making up phrases as I go here, but it sells those different tranches off to investors and it profits in the middle. It makes a
correct.
split, right? Because they're
They
buying
make
the
an
loans
advisory fee,
from, yeah, they
right?
get an advisory fee. They're taking the loans from you guys and they're going out and they're selling them off in different tranches to investors. And so the investors are getting paid as those mortgages come in. Wall Street gets an advisory
Right.
fee. Y'all sold the loans and you make a lot of money. Is that how the whole process works?
So we actually don't sell the loans, but think of it as like a bank. We still own the loans, but
Okay.
the financing that we've matched up against it is attractive. And so today, in the current market, let's say interest rates to the market, like what we would lend to an investor, might be 7%.
Mm-hmm.
Our all-in financing on the securitization might be 5.5%. And so the way we make money is that difference between the 7 and the 5.5, something like that. So we hold on to the loans. We now have permanent financing against it. So very similar, again, back to what I said early on. We're borrowing money to lend money, and we make
Yeah.
money on the spread in between.
Okay. So you're borrowing money from the investors who are purchasing the
Mm-hmm.
securitizations, right? You're borrowing money from
Yep.
those guys, and then you're going out to the market and it's getting relent out at the let's call them the like mom and pop investors who are buying the single family homes. There's two
Correct.
investors here. There's the investors that are paying for
Yeah.
the bonds, the
Exactly.
securitization, right? Giving you guys money. And then there's the investors that are out acquiring
Yeah.
the single family rental properties who invest and you're lending it out to them at 7%. So you're collecting. And so that's
It,
how the whole process works.
Exactly. And so this conversation is a perfect example of we talk about bringing Wall Street to Main Street, or you could bring Main Street to Wall Street. These two worlds, they don't talk each other's language very well. Wall Street's got a whole bunch of Wall Street lingo, and folks on Main Street tend to be very practical, pragmatic, like focused
Yeah.
on what kind of cash flow do I generate, and did I get a good deal on the property? Getting these two worlds to talk to each other and figuring out how we could design a loan product that meets the needs of the investor, but also works in the bond market. That was kind of I would say the key thing to what started Visio.
Okay. So how did you do that? I understand the residential buyer list. In fact, let's
Yeah,
talk about that. So let's talk about how you married those together because you've got the investor needs that are actually giving you the money, like they're purchasing the
right.
securitization. And then you got the investors who are out there in the market that are actually buying the rental properties that you're lending money to. Let's talk about the investors who are buying the rental properties that you're lending money to. What problem did this solve for them?
Right. So let me talk about what the financing alternatives were prior to the emergence of a DSCR loan. So in the agency space, so agency, think of Fannie and Freddie type loans, the type of loans you or I would use typically to buy our home.
Mhm.
So agency financing is available for investment properties. You can, and but to qualify for that loan, you're going to have to qualify initially. Think of if you're purchasing a new rental property, you're going to have to qualify based on your personal income. So when you go to apply for that loan, they're going to say, okay, send me your pay stub, and I want to see your tax returns, and I also need to understand everything about your personal assets. I want to know about your credit. Um, and in the past, that loan, it was cost effective if you could qualify,
It's a
right? And so
huge headache, even if you
it's
do qualify. I'm here. I'm raising. It's a huge
right.
headache.
Right. And that's because a lot of investors, like you look at their tax returns and it's everything is above board, right? But you're able to depreciate certain things and the like. And so your tax return may look like you don't generate all that much cash flow. Many real estate investors are only they may be self-employed, or they may be part-time employed. So those agency loans, as you just said, can be very complicated to qualify for. But in the past, they were really cost effective. They were like the cheapest financing if you could get it. On the other side, you could go, if you had a relationship with a local bank, you could go to a local bank and they have more flexibility in how they would qualify you, but they're still going to ask for your paycheck. They're going to ask for your personal financial statements. They want to know everything about your assets. And the thing with local banks, as I said, they really can't do 30-year term. They usually put balloons in them. And then the other thing about local banks is local banks are sometimes their financing's available and the next month it's not. And it has to do with, did they just do a big commercial deal? Or they're always having to balance kind of their buckets of loans because of the regulatory oversight that kind of watches what they're doing. So as an investor, the challenge with that is, hey, I just found a great deal. And last month you financed me, like you go to the local bank and they provided financing. And I go to them this month and they say, hey, that's a really great deal, but I can't finance you this month. And you ask them, well, why? And it's like, it has nothing to do with you. It has everything to do with other things going on in the bank. And so the financing's not reliable, which is really hard if you're trying to build a rental portfolio, because you spend a lot of time trying to find the good deals. And when you find the good deal, you need to know that your financing is available. So that was the landscape prior to DSCR loans. And so,
Let me just piggyback on that to give you an example. I had to sell several of my rental properties because I think I had like 5-year balloons on them, I want to say, and it came up rate. I had like a 3% interest rate on 4%, and it was like 6.5, 7%, something like that. And I was like, all of a sudden, my rent didn't cover the mortgage.
right,
The debt didn't service
right,
the loan, essentially, where my rents didn't service the loan, so I was forced to sell those. So that's a problem, right? I can't hold that asset anymore.
right.
I'm forced to sell it. I just want to give that example. Please
That's
continue.
That's a great example, and it's going on. That's going on in spades right now in the multifamily space, because there's not a lot of long-term financing available on multifamily properties. So what you're describing is happening in spades for multifamily folks. So what we saw in the market was, okay, how do we write the equivalent of a commercial mortgage on a residential property? And when I say a commercial mortgage, how could we design a loan product that had 30-year term that you could underwrite the cash flow on the property level rather than the person's personal income? How could you do that and get that financed? That's the question we were trying to answer. And so we partnered up with this credit fund out of Southern California that had a lot of expertise in the mortgage-backed securities market. And it's not that we were completely inventing something. We were kind of reinventing a concept that had been around prior to the financial crisis. But we really had to do it in a post-financial crisis world, and get rating agencies, bond investors comfortable with this whole thing. So what a DSCR loan is instead of looking at your personal income, we look at the property level cash flow and we compare the rent that comes from the property to the monthly payment on the property. And so we underwrite the loan based on your personal credit, both your credit score and the depth of your credit, the debt service coverage ratio, how strong is the rent relative to the monthly payment. And then we underwrite it based on loan to value. And so in our space, in the DSCR space, on purchase loans, we require a 20% down payment. And on refinances, cash out refinances, we can go up to like a 75% loan to value. So if it was a $100,000 property, we could lend up to $75,000. So that was really the establishing a framework for that. And then some other requirements. You mentioned earlier reserve requirements. So in the DSCR space, the reserve requirements are less strenuous than they would be on an agency loan. And then another very important thing was, we actually enable you to finance your property in a legal entity. So if you can own your rental properties in an LLC or a corporation, whereas on an agency loan, you can't do that. Agency loans require you to hold it in your personal name. And we think, it's our opinion, for investors, holding your properties in LLCs or corporations we just think is good risk management. And so to us, we think that's incredibly important. And, while it's not our job to tell people to do that, we just think it's an incredibly valuable feature to be able to segment assets from a risk management perspective in corporate entities.
Makes a lot of sense. Sounds like y'all, like, banks are, the benefit with banks is it's usually cheaper money, higher loan to values, 80%.
Right.
The cheaper money, higher loan to value, more leverage, but again, headache, you can't scale it. And there's a lot of issues that could potentially pop up, right, with personal stuff that they require, or if something happens and there's a banking crisis because the interest rates went up and SVB bank sells and yada, 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 and everyone rushes to
Right.
the sidelines and all of a sudden you can't get money. That's a huge, huge benefit there with this product. You guys are saying, hey, let's be more conservative, 75% LTV, 20% down payment. Let's look at the performance of the asset more, right? Like you do on commercial, and let's underwrite it based on those assumptions.
Correct. Yeah. No, that's exactly right. And when we introduced this, there's some complexities on Wall Street because, again, it looks like a commercial loan written on a residential property. And so, just not to go too far into the weed, but
Yeah.
Wall Street's kind of all built around, there are people who look at residential mortgage finance and there's people who look at commercial mortgage finance. And we were trying to put those two worlds together. And so that required us to do a lot of work with rating agencies like S&P. It required us to do a lot of work with end investors in these bonds because all the investors are structured the same way. Hey, this is our team who does residential stuff, and this is our team who does commercial stuff. And when we showed up and we said, hey, this is a commercial loan on a residential property, they kind of they kind of cocked their head like, I don't know what to do with this. And as we explained it a little bit more, it was like, okay, they're like, I get it. This all makes sense. So this was back in 2016. Today, billions of dollars of this have been originated. And this is a mainstream product. And the reason that's important is now the DSCR loan is not materially more expensive than the agency loan. So the DSCR loan today is more flexible. It's less paperwork to qualify for. It offers the ability to finance in a legal entity, and it's probably no more expensive than the agency loan equivalent. And that's just a function of the market has now become more mainstream, and there's a lot more support on Wall Street for this type of financing. And so that's kind of brought the financing into parity.
Wow. Okay. So we've figured out how to solve the mom and pop investor problem, guys out there who are acquiring single family rentals. What was the problem with the investors that were purchasing the bonds? You said you solved two issues there on both sides. How did you do it with the bond investors?
Yeah, I think with the bond investors, it's a lot of this. So performance is the critical issue for bond investors. So no one on Wall Street, folks on Wall Street don't like to be the first, and so it's one of those things that you have to find the right investors who understand the story and they're willing to kind of step in first. And so as the company that was originating these loans, we had to have a medium to long-term perspective that, on the early deals, our financing is not going to be what it should be in the bond market. But as we do more deals and they get more comfortable with the fact that these loans actually perform extremely well, then more people will become interested, more investors will become interested. There'll be more depth of capital in the space, and that over time, it'll become things will come into a better alignment. So I would say for us, a lot of it was effective storytelling around here's the value proposition, and here's why these loans make sense, and to the best of our ability, supporting that with maybe indirect data to support how these loans would perform. and then taking a long-term perspective that, you know what, it's going to take us time to get to where the financing cost really should be. But if we do this right, we're going to be able to, deliver something of tremendous value to our customers. And so I think that's played out. And you're in this business, you understand it. Small investors own the vast majority of the single family rental properties in this country. Regardless of what somebody reads in the newspaper about all the hedge funds that have bought all
Yeah.
these single family rental properties, they own a tiny fraction of the
Yeah.
single family rental properties. And it's the small investors around the country. And when I say small, I'm talking, 10 to 50 properties. It's not real small, right? Somebody who owns 50 properties may have 15 or $20 million of single family rental properties, but they are the crux of the single family rental space, and they play an incredibly important role in this whole affordable housing discussion, right? Because most of these homes need some level of renovation before you turn them back into full-time rental properties, right? And it's not first-time home buyers who are going to make those improvements to those properties. It's small investors. And
Yeah.
so, for us, this is we think this is an incredibly important part of the equation of just, the housing strategy in this country.
Yeah, 100%. I'm curious, and maybe you don't come from this side of the world, the commercial world. So if you don't know the answer, this is no big deal. But I'm just genuinely curious, why is it that you can get a long-term 30-year fixed rate debt product if you're going to like live in the property? Or now it sounds like you guys have something that if you are going to rent it, that you can offer. You can get a 30-year, fixed rate product. Whereas in the commercial world, that's not a thing. Why is that? Why can't I go
Yeah.
get a 30-year fixed rate debt product on a big commercial building?
Well, I'll just give you one part of the equation. I don't think I fully could give you a complete answer.
Okay.
I think the one part of the answer I would give you is there's a public policy decision in this country that home ownership is valuable to our society. So, really, 30-year mortgages are largely a function of agency support, Fannie and Freddie, which are today owned by the government. Their support of the mortgage market. When you survey the world and you look at how people finance homes around the world, most countries do not have 30-year mortgages. And so, I would just say the idea that we have the ability to buy a home on a fixed rate mortgage where the interest rate doesn't move around for 30 years, that's very unique. It's not unique's the wrong word. It's the minority situation around the globe. That is not the way most people around the world are able to finance their home, if they're able to finance their home at all. So that same policy decision has not been made from a commercial real estate perspective, that our government should make 30-year financing available so that you or I can buy an office building or a strip center.
Okay. That makes a lot of sense. It all boils down to the government. What are they going to back? They don't want to back the commercial world. They want to back Main Street. Okay. That makes a lot of
Right.
sense. Jeff, this has been
Yeah.
an absolute pleasure. We're coming up on the end here. If people want to learn more about you, learn more about Visio Lending, where can they go?
Yeah. So the best place to go find more information about us is our website. It's Visio, VISIO lending. So not a Z, VISIO lending.com. And I know your audience is broad based. You've got folks who own rental properties. You got folks who work in and around the investor ecosystem. One of the things I would just encourage folks, we didn't talk about this, but in our space, we work with folks who quote unquote broker loans to us from all walks of life. In most states, you don't have to be licensed to broker DSCR loans. And so if you're involved in real estate investing and you know other people who are, and you want to become much more knowledgeable about DSCR loans, you can help them by essentially serving as their intermediary, help them with their financing, and you can earn money to do that. And so it's one of the unique opportunities about the DSCR space. Again, we have customers who are also brokers. We have realtors that are brokers, property managers that are brokers, and then obviously lots of mortgage brokers that broker these loans. So it's just an interesting revenue stream for people to consider.
That's very cool. We'll make sure that that gets posted in the show notes. Thanks for coming on the show today and dropping some gold bombs and explaining the whole mortgage market to us.
Right on. Thanks for having me on.
Yeah. And hey, if you're listening to this, show Jeff some love, show me some love, subscribe, share this with your friends and family. We will see you guys next time.